In the meantime, got to talk about this. Stocks tumbled on Tuesday amid speculation that the Federal Reserve will launch another big interest rate hike. That's one of the steps being taken to curb inflation. All areas of the economy are impacted by this, including housing. The Mortgage Bankers Association reports applications rose this week for the first time in more than a month. The average rate on the most popular U.S. home loan, that is the 30-year fixed rate mortgage, hit 6.25% today. A 15-year fixed rate mortgage is now at 5.85%. So, what do all of these numbers mean if you're trying to buy a home? And we know many people are. Jeff Phillips is here to put it all into perspective for us. He is the president of the Southland Regional Association of Realtors. Thank you for being with us.
Thank you for the opportunity.
Of course. All right. So everyone's feeling it. Inflation weighing on the economy. Gas, food prices, utilities, everything, you name it, it's happening. Can you explain how inflation is impacting buyers and sellers in the housing market?
Well, the direct answer is that with higher costs, we're seeing reductions in expendable cash. We're seeing a decrease in savings. But for buyers, for instance, we're seeing that it's harder to qualify. Interest rates going up make affordability a little more difficult. To counteract that, we're going to see a reduced competition for properties, so sellers are going to have to lower their prices, which would impact what a seller may get in return on their equity. We may see a slowdown, a temporary slowdown in the market as things start to shake out and correct. So obviously, paying more for things is going to affect things like repairs and services that sellers have to provide in a transaction as well. So it could definitely impact both the buyers and sellers right off the bat.
Yeah, it's kind of a domino effect, isn't it? You know, today the Federal Reserve is expected to raise interest rates 0.75%. Can you talk about what another rate hike will do? Say, for example, a 30-year fixed mortgage rate, which is the most common type of a home loan.
Okay. Well, right now, obviously, the first is, again, interest rates are going to go up, and we're going to feel that. So it's going to be harder to qualify for loans. But one of the biggest misconceptions is that the Fed rate is not directly tied to mortgage interest rates. The thought is that if the Fed were to raise rates by 0.75 of a point, that mortgage interest rates would as well raise by 0.75 of a point. It's just not true. The Fed rate affects things more like our credit cards and our auto loans and our personal loans, while the mortgage interest rates are more dictated by bonds and securities and things like that, like our 30-year bond, our 10-year bond. It does have a indirect impact, obviously, because it's changing things in the market. But, you know, a 30-year fixed, obviously, is a great loan. And even at the rates that we're seeing now, we're still historically lower than we've seen in quite some time. The historical average being about 8%. So we're still in a decent position, even though it's not exactly what we'd hope for.
What about the impact to, say, the adjustable rate mortgages? I mean, what's the option when it comes to home buyers with that?
Well, the difference between the 30 and the adjustable is obviously in a 30, you're locking your rate in, and so any effects or changes aren't going to be felt past the point of locking that in. Where an adjustable, we're going to see a raise in initial rates because there's different pieces to an adjustable. There's a correlation to an index as well as a margin rate. So we may see the starting rate start higher because of the increase, but not locking in and having that float around, it's subject to being affected to future Fed hikes or changes in the market where, again, your 30-year fix is more stable and more reliable.
Jeff, before we run out of time, we hit the buyers, the sellers. Want to talk about what conditions are doing to renters. How does inflation impact people who are renting homes? Also talk about the mom and pop landlords.
Okay. Well, obviously, the cost of living and all of the products and services we're buying are going up. Again, it reduces our expendable cash and our savings. but it also forces landlords to have to potentially raise rates. As costs rise, we may see renters have difficulty meeting their mortgage payment, which again puts pressure back on the landlord because they may have a mortgage attached to that property that they need that income to pay. And then cost of maintenance, because again, products and services are going up. It's harder for landlords to make these changes or improvements to properties that are mandatory in some cases. And then, we see both sides, struggling. Renters are going to have difficulty paying, and landlords may eventually have to raise rates to offset the cost.
Jeff, thanks so much. Really appreciate you being with us this morning. We covered a lot of ground. Take care.
Thank you. I appreciate it.